Welcome, everyone, to tonight's Hookup with Real Estate Masterclass. We're super excited to be here and share tonight with our special guest, Douglas Escobar, who I'll introduce in just a few minutes. But first, we have some housekeeping we need to take care of. So, Stefan, would you please read the disclaimer?
Yes, okay. We appreciate your attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice, nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hookup with Real Estate and its representatives are not liable for any outcome resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. And by attending, you consent to this event being recorded and understood that internet security is not absolute.
Thank you. We get rid of the risks. Okay. So my husband, Ken, who was unable to be here this evening, and I have a mission, and it's to empower aspiring and early real estate investors with exceptional education, invaluable skills training, and genuine opportunities to invest in real estate while simultaneously sharing strategies that guide you toward success in real estate and away from costly mistakes. We made our fair share of costly mistakes, which you can read about in the book, Real Women in Real Estate. It's either on Amazon or I can send you a signed copy. Ken is a licensed real estate agent in Northern New Jersey. So if you're in this area or you need a referral, you can reach him at kenneth-hook.weichert.com. We are part of the Legends Equity Group, and we invest in syndication, and it's a great community that has challenges and training, and there's a school community, skool.com/real estate club. Now, there's a great event happening in Las Vegas on January 8th through the 10th. It's called the Legends Breakthrough Event. This is not specifically about real estate, but it's about the mindset shifts that we all need, to break through to be able to, be stronger, be better, be more confident. And I went to the last one. I'm telling you, it's fabulous. So there is a website you can sign up on, and just take a screenshot of that if you're interested. There is a fee, by the way. It's $497, I believe. Another thing we're involved with is core tax deeds. This is in Texas. They're investing in tax. We're investing in tax deeds. I can't talk much about it because by law you have to be on their website, invest.coretaxdeeds.com. But if tax deeds is interesting to you, and this is for non-accredited investors and accredited investors, at least through the end of the year, it's a crowd-funded platform, so I can connect you with the founder. And lastly, for accredited investors only, we're invested in industrial flex, and we do have several investment opportunities available. Both properties right now have already closed. So there's just a final post-close raise that we're looking at. Okay. Then, if you're interested in finding out more about how to invest in real estate, what real estate is right for you, or you have any questions, you can book a free strategy call. We provide real guidance, real strategies, and real investment opportunities. And there's two ways you can connect with us besides LinkedIn. I'm on LinkedIn all the time. That's where Doug and I met. But we have a YouTube channel, and this is where all our replays are. YouTube.com// the @ hook up with real estate. And we have a Facebook groups page, groups with an S, at Hook Up with Real Estate. So you can like and subscribe or join there. Now, this is our calendar. We are here in November with one more month to go. As noted, because it's in red, it's an altered schedule. So this one will also be on the third Wednesday so as not to conflict with the holidays in December. All right, and I am letting you know that our 2026 calendar is now available. Similarly, November, December will be on the 3rd, and I have a typo here, so I'll fix that for the next time in July. But anyway, this is the general idea. We'll be on the 4th Wednesday. And Stefan, could you please read the quote of the day? You're on mute.
Okay. Quote of the day. Risk comes from not knowing what you're doing. Warren Buffett.
Thank you. And now we get to the good stuff. I get to introduce our special guest. Douglas Escobar is the former global head of claims with over 17 years in the insurance industry, managing billions in exposure. He's since become a real estate investor and has fractional equity ownership in over 2,000 multifamily doors and rental units. Douglas is also a speaker, author of the book Work Optional, and founder of ESC Freedom Investments, where he helps high-income professionals escape their W-2 dependence and build true financial leverage through passive investing. His proprietary Work Optional Wealth Blueprint was developed through his own journey, realizing that corporate security was an illusion and building an income portfolio that worked whether he did or not. This framework, grounded in real risk management, not hype, is now being passed on to other professionals ready to buy back their time. At ESC Freedom Investments, Douglas combines data-driven deal vetting with plain-spoken guidance to help investors deploy capital with confidence. His mission is simple: empower others to make work optional, not someday, but sooner than they thought was possible. Please help me welcome Douglas Escobar to present his ideas on the Work Optional Blueprint, how to become financially free investing in real estate. I'm going to stop sharing. Nigel. Thanks. You, Douglas.
Thanks, Donna, and Sevan, and Ken that is not here. So for having me in your podcast and your show, I think it's an honor giving me the opportunity to talk about some of my journey. Hopefully, some of the things that I that I accomplished and some of the lessons learned along the way, can be shared with the group, and hopefully some of that can be helpful in people's journey. So
yeah, that's great. Before you get started, we always like to ask our guests, how did you get involved in real estate? Or how did you get started?
That's a great question because it takes me back to 1999, 1998 type of time. So I'm giving away a little bit of my age here, but so if you remember those infomercials, Carlton sheets and books of Robert Allen, and Robert Kiyosaki type books. Okay, those are the three people that kind of like got me into real estate, just at least from a mindset shift. So in 1999, quickly I bought my first condominium, and I had a friend, a very close friend of mine, that he was in big time in real estate in Michigan, and he came to Florida, and actually he gave me $2,000 and said, "Hey, you want to get in real estate? Go and get this condominium that you wanted." And I went and got it. Um, long, no, long story short, um, I sold that condo a year later for twice as much as what I bought it for. So that kind of, I said, "Oh my God, this is possible," right? So, um, so I got into the money down, no money down, strategies that were being taught in those courses, right, by Carlton Sheets and Robert Allen. So that got me into the group of investors, and I built a portfolio of single family homes, about maybe 12, 15 homes at one point. Sold them all in 2006, '07, coming into the crisis. And I sold them because I followed the advice of a mentor, okay, against my best, I guess, desire of keeping it. I followed his advice, and it was a great advice at that time, obviously in hindsight. So, first, we kind of fast forward, to 2014, I got into real estate, multifamily, and that's how I got into real estate. So that's and here we are, $2,000 later. Private credit funds investments, uh, work optional since 2024. We're here.
Amazing. Yeah. I have we bought the book Nothing Down for the 90s by Robert Allen, and we went to a couple of his conferences in Chicago. And yeah, but it was a great book for its time.
Yeah. So
Always.
let's for me, I can start sharing now. And I think
Okay.
just before we start sharing it, just a little bit about you read the intro first. Thank you very much for that. Navigating through corporate America layoff and restructurings, for almost 17 years is not a pleasant thing to be in, as you know, Donna. Um, I was fortunate enough to survive all of them, right? But I saw the devastation that it created in thousands of people, and hundreds of them were close friends of mine at one point. So that was a wake up call that I had, at one point at 3 a.m. in the morning, and said, through the downsizing periods, and I said, it's just that lingering question, will I be next? And that's really what motivated me to go back to real estate and start learning everything I could about multifamily. Didn't know anything about it. I just got back into getting people that I knew were in it, and kind of they were saying this is the way to go at that time. So that's what I did it. So that was sort of a kind of recapping the intro that you gave and what it is. So I became work optional in 2024. I'll go ahead and start sharing some of the talking points, so people can follow along if you give me a second here.
Yep. Take your time.
Come here. Let me go to the slideshow here. Okay, give me a second. For some reason, bring me back to where I needed to be. Here we go. Let's go to some. There you go. So this is the beginning of the. So we talk about work optional. That's the title of my book. Is a risk managed path to passive income, and that was born of my journey. Not that I don't think anybody wakes up in the morning and says, "I'm going to write a book." It just happened to happen, and you don't think you have a story until you start talking to people and they tell you have one, and that you should write about it. Okay.
So what did work optional mean to you when you picked that title?
Yeah. So what I meant by that is people talk about being financially free, retiring. That's not what I wanted to say. What I wanted to say is to break away your dependency from your W-2, from your one source of income, from your commissions, whatever that single point of failure could be. And if by diversifying and building other streams of income, you could become more optional, meaning you work because you choose to, not because you have to. Okay, so that's not about retiring, and it's not about inviting anybody to quit their W-2. This is not what this is all about. This is about letting your W-2 fuel your investments. That's really the message behind this. And eventually, any decision you make it with confidence, with patience. There's no hasty decisions because you have that plan B already in place, and you're becoming immune to the market shocks or the different people, making different decisions at any given point in time on your life. You simply, you control your destiny. So that's really what I mean by work optional, right? So I hope that is clear to everybody, but that's exactly what I mean by that. Okay.
Yeah. Thank you.
Okay. So, what is this masterclass for, or this journey that turned to be a masterclass at the end of the day, is for those professionals that are basically depending on W-2. I think I already say that. Those people that are concerned about layoff. Now we have I would say the imminent threat, and I say that with caution, of AI and automation. Okay. AI is a benefit to everybody, but also let's be realistic, it'll displace a lot of people. Okay. But if you embrace AI and make the best out of it, you probably develop other skills that are emerging as a result of that. So, and for those people that are really seeking for predictable, tax efficient passive income. Okay. And the reason I talk about tax efficient, even though I'm not a CPA, I'm not giving any advice, so that what I learned throughout my journey, that becomes a part of your game plan, whether you like it or not. And as you start getting into that, your accountants and your CPAs will drive you to that path to understand the best way to optimize your investments and the benefits that are provided by real estate, as outlined by the IRS codes. Okay. So this is what this masterclass is for.
Right.
What I hope people walk away from this is a clear work optional roadmap. It's not complex, it's not fancy, it's not exotic. It is a simple step-by-step that most people probably know about it in its own different levels, but never combined together, right? And when you put it together, it makes a powerful roadmap, so clear that it just takes time and discipline to do it. You also, we'll talk about how to evaluate deals and sponsors like a pro. The truth about private credit versus multifamily, what type of engines they belong into, and how to build a resilient passive income portfolio. Okay. So how this is the walk away from the presentation. And I invite anybody to step in and have any questions if they have. Obviously, I hope this becomes interactive and not just a mono presentation of a single person talking about this. Okay. So what's the problem? We talk about the dependency. To me, that's the main problem with the work optional is, in insurance, we talk about concentration or risk. So when you think about your W-2 dependency as a single source of income, that's concentration risk, okay, in itself. You have no, if you stop showing up, does that mean that your income stop showing up as well? Yes, more likely, unless you have other ways to supplement that. AI automation is increased volatility, okay, that is coming. Income is not the same as security, okay? That just, let's be clear with that. It just doesn't mean that. You can be highly paid, highly compensated, but that doesn't mean security, okay? Predictability removes fear. I mentioned that in the prior slide about you make better decisions, you build patience, and you build confidence when you have something that is predictable. Once you have a process that prints money, right? Fear, volatility, anything that creates uncertainty gets diminished. Okay. So we talk about my story and talk about my early real estate cycle, my 3 a.m. wake up call. It was all driven by layoff and restructuring. And just to give you a perspective, in 17 years, when I joined the company that I work for, which I'm very thankful for, for all I got from them, we were 90,000 people worldwide. When I left, we were 25,000 people or less. So that's a massive restructuring, okay? So
That
think
is.
about that, because that's huge, okay? I built multiple income engines. And like you stated at the beginning, I have fractional equity ownership in over 2,000 units, plus some other type of income from private credits, okay? Funds. So that's really the story and the journey of myself. Now let's talk about the blueprint, okay? This blueprint is basically under the umbrella of one thing. You had to have clarity in your goals. Without clarity in your goals on what you're heading, what you want to do, what you're trying to achieve by creating multiple streams of income, without that, none of this works, because you'll take missteps around the process. So, if your goal is to replace partial or total income or cover your essentials, that means you need cash flow. And including myself, we start the wrong way, right? When we start investing, we invest in long-term versus immediate cash flow. So we tie up liquidity, and if things don't go as planned, then we really didn't do us a favor at all. Anyway, so once you align your goals and where you want to invest, you got to understand what that number is, what that magic number is, what your freedom number is. Okay. If it is 3,000, if it is 5,000, it is $7,000 a month that you need to survive. That's what I call the freedom number. That's what you need to audit your financials. Okay.
So that's your basic expenses, or even all your expenses. If you want to take a trip,
Yeah.
you have to include that.
You define what your essentials are, right? That's up to you, right? Some people will not include that trip that they want. They want to have the minimum. So they get a minimum. So people say, well, I make 2 trips a day. Now you're talking about funding your lifestyle, So you decide what the freedom number is, and that's how you apply it. Okay. What's the number that allows you to step away from your W-2? That's the number you ought to be looking for. Okay. Then we talk about two, it's actually the 3 engines. The income engine, which is, in my experience, comes from private credit funds. Those are short-term, more predictable cash flow. And then you got the growth engine, sort of like the multifamily, that are long-term. There are equity growth, tax benefits associated with that. Then we send up blueprint coming from the insurance industry. Anything that we do, we put risk guardrails around it. We take care of the downside protection first, and then we go second for returns. So that's where that rule from Warren Buffett. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Okay, so that's the kind of the risk guardrail framework. Then I talk about the tax optimization, which is your third engine. And again, as a disclaimer, I'm not a CPA, I'm not an accountant. So consult all your professionals, your financial advisors, your CPAs, whoever you need to consult when it comes to any action you're going to take. This is just giving you some of my own journey, in my experience, It doesn't mean it will be the same as yours, okay? Or it's actually the same scenario, same situation. But the framework in itself, it is a roadmap. When I talk about liquidity sleeves, is you had to think of now today, and you had to make sure you get your reserves in place. And that's basic savings, basic one-on-one, right? You know, how do you cover for emergencies? You know, you cover for 3 months, 6 months, 9 months, 12 months. That's up to you. You decide how far you can go and what's really healthy to have. Okay. And then you had to have tracking and visibility systems in place. And I don't mean anything fancy. It's just a tracking mechanism of how any of these investments are going. Okay, at any given point, you can do it monthly, you can do it quarterly, subject to how you get reporting from your investments. But you
Can
know,
I ask you a question?
yes, sir.
Is there like a mathematical formula? So, for instance, if my freedom number was 35,000, hypothetically,
Mhm.
was 50,000, is there a formula available to determine how much I would need to start up? And you understand where I'm going with this?
Yeah, yeah. So how many deals you need to get in to get that kind of money? Is that kind of you're saying?
Yeah.
So I guess it boils down to that to some extent, but there are many other factors. The short answer is start now, start small, or whatever makes you feel comfortable, and build momentum. So don't worry about the number of deals, as it will get to it eventually, right? But if you think about, oh, I need to invest, I'm gonna just give you a number here, $50,000 per deal that produces 8% pref return every year. How many of those deals do I need to get to replace my $35,000? That might, just from the get-go, that might just shut you down because you think it's not reachable. Rather than think saying, hey, how do I cover my car payment? That might be 350, 450, 500. What kind of investment can I make to cover that expense? Right. Then you go for the second expense that you want to, how do I cover my mortgage? Right. Um, that's called the essential. So you start looking at in steps, what's the vehicle that you need to invest in? And how do you reinvest those profits that you may get, those upsides you might get in time from those investments? You start double down. So again, every scenario is it boils down to taking the massive action to get to where you want to get. You can make it mathematically. You can absorb that shocking number that you want to think that you may not reach, but you'll be surprised. So when I talk about this, about high income earners, it's because, and Donna, the audience may or may not be, but the principle still holds true for anyone. My point is, when you're thinking about investing in alternative assets or investments, you very well said at the beginning of your introduction, you got 506B and you got 506C. You have accredited and non-accredited, and there are requirements from a high net worth or from a salary perspective that they need to fulfill in order to be accredited investors. So, but if you don't fit any of those buckets, still you can look at getting small steps, small investments, especially in the 506B world. Okay, it's easier to start smaller than it's in the 506C. Okay, so my answer to that question, Stephen, is don't worry about the number of deals. Just start with something, and you build momentum. Okay, and I will say build something that is more predictable than exciting. Okay, because exciting means always takes longer, longer play than what your actually goal might be. Okay. Um, I don't know if that answers the question, but that's what I gave all the time when people ask me that question, because I get asked that question.
It does. So then the next question is, let's say a person doesn't want to manage the properties themselves? Do you does your company allow for someone to join?
Yeah.
And
So you're talking about active and passive roles, okay?
right,
So active is someone who owns and manages their own properties. Is that what they like? They should look for that route. And the framework is the same, okay? But if
right,
you, like me, I already being an operator before, I own the portfolio homes. I decided to, because of my type of corporate work that I had, I really didn't have the time to go and start syndicating and running 150,000, 2,000 units on my own. I needed a full team. I let my W-2 fuel my investments and became a passive investor. Well, I invest in real estate syndications, and invest in private credit funds. I do my work on the front end. That's the risk guardrails that we talk about before I invest. And then I just trust the process because I do my due diligence. So you choose either your active role or your passive role. That's up to you. Okay. I chose the passive role. Okay. And it might take a little bit longer because you have more patience, but it will get you to the same destination as if you were active. If ultimately what you're looking for is to live of passive income, eventually you need to become just an investor. That's the quadrant of Robert Kiyosaki, right? You ultimately become an investor either by buying businesses, not that you operate businesses, but invest in them, or you invest in opportunities and ventures and in multifamilies and in other type of investment that are out there. Okay. And I always go back to the who, not how, right? It's just who is behind the deal. And we'll talk about the guardrails in that end. Okay. So that's basically that's the blueprint. Like I said, it's not simple. It's not sexy. It's not complex. And everybody probably knows a little bit of this in its own individual terms. But when you combine them all as a framework, and this is not something that I developed before I started. This is something that I realized I had done. That I went through this and say, man, I did all this, right? And it became that roadmap. Okay. So we'll move to the next one. So what's the income engine, right? The income engine is your cash flow machine, right? I'm a cash flow guy. I want money now. I'm okay with appreciation in a lesser scale, but I want money now, right? Something that is predictable. I buy assets that pay for my liability. I invest in assets that pay for my liabilities. Okay, that's what I do. So income engine is basically collateral backed lending. That's the type of asset that I look for. Diversified notes. What that means is it's a portfolio base. Not a single note or a single unit can bring the portfolio down. Okay. That has monthly, quarterly cash flow, and that is highly predictable, which is better than excitement. The excitement could be an upside in 4 years. You can get, double your money, but the most of that money will come toward the disposition of an asset or capital event. So think
Just
about
to explain that, that's when either the property sells or might refinance.
correct. So I look at portfolios and that are diversified either geographically in one single asset, but geographically. For example, I invest in a portfolio of rehabbers and flippers that had a very stringent and rigid underwriting due diligence, and I participate on the mezzanine preferred capital stack, meaning we're in second position of the loan. Okay.
Okay, so just to explain the capital stack a little bit, that just means the order in which people are getting paid. So the bank is always at the top. Then,
Actually, on the bottom, but it's the most secure and less returns. And then goes
oh,
the pref and the mezzanine. Because second, it is a little bit higher return, gets paid after the bank, and then comes common equity on the top, which is the highest return but the highest risk. Okay.
okay. Thank you for correcting
Great.
that.
So anyway, so that's your income engine is short term, give you some sense of liquidity, commitments of maybe 1 2 years. That means that redemption cannot happen before that, but you get this kind of quarterly and monthly cash flow. That's your income engine, okay? This is my fuel today. For me today, in my portfolio, that's my fuel, okay?
So what kind of short-term debts are you talking about? Fix and flips you're
It could be
investing
fix
in?
and flip like exactly 12 month, 9 month projects, okay?
Okay.
But I do it, we invest on the portfolio, like maybe we may have 500 loans out there, right? In different geographies, for example, or maybe 1,000 loans. Okay.
Okay. So how does the average person go about finding a fix and flip for portfolio to invest
I
in?
mean, either you are in the inner circles of the private markets, it'll be there, or you can Google any credit funds, private credit funds, and will come up companies with that. Okay.
Okay.
That's
Thank you.
really what it will all down.
And is there usually a minimum in those environments?
So that's a great question, Donna. Most of these private credit funds are 506C, okay? Because they publicly uh, marketed or promoted. So most of these funds will start about 100K,
Okay.
okay? And that's sort of a high entry barrier for a lot of people.
Yes.
And number one, if you're going to invest, you should invest something that will not mortgage your house. So
True.
that's very important. So if you're going to invest 100K, it's because you can afford it. And you think about affording it means you might not see it again. It's not that's not how we evaluate deals. But when you invest, think about the fact that's not going to break your lifestyle. It's not going to take away your tuition for your kids or when it's something like that. From
Yeah.
that lens, I'm talking about, right? Not that anybody wants to lose 100K. I'm just saying you might gotta be careful, with your investors because you're not breaking away. And that's why you had the 506C guardrail.
Mm,
You had to verify that you're an accredited investor, and therefore you can assume that kind of risk. Okay.
gotcha. Okay. It was good to know.
So let's go to the growth engine. The typical multifamily deal, especially in a value add, it's a truly growth engine. You have cash flow distributions, either a cash return or you had a pref return, meaning that after the lenders gets paid, the next in line is those investors that had a pref return before the sponsor, the general partner, and the can get any type of profits on that. Okay, it gives you a long term because you're looking about 3 to 5 years is the typical. There's some about there that are 7 years. Not very popular. 3 to 5 years is already long, but that's a business plan that it takes to turn around a property, right, from being in its classic state, meaning never being renovated, rents are below market rents. There is a big potential for the upside when it's being all renovated, and then by the time they sell that property, you get your money back through a refi, like you said, or basically, if you want to hold it longer, they do a refi and get you capital, and you continue to receive cash flow based on the equity in proportion to the equity that you participated in. There's depreciation advantages from a tax perspective. Always talk to your accountant about that, okay? But it's helpful when you have, from an investor, that has passive income and passive losses. It's important to reduce the tax liability, okay, on that.
Yeah. And I mean, if there's someone in your household that's a real estate professional, there's a very big different.
Very big benefit, yes. Okay. And
Big
then
benefit.
you got the equity. That's the upside, right? The equity is the upside that you gain through a value up. By improving the property, you improve the rental income, you improve the net operating income. Therefore, the appreciation of the building is much bigger in 3 to 5 years. And that's what everybody benefits from that. Okay. So that is a growth engine. So I got part of my portfolio into that as well. Obviously, that's how I started. Okay. Just as recently as maybe the last 2 years, I switched more to the private credit piece. Once I got an understanding how that worked, I just didn't know anything about it 10, 12 years ago. So then let's talk about the risk guardrail. So when you're investing, right, as an insurance professional that manage large losses, that assess risk, price risk, and mitigate risk, you always focus on the downturn, the downside protection first, and then in the upside or the return. Okay, so there's 4 things that we look here in investment, especially in the it applies to everything, but in the multifamily, is the sponsor selection, the capital stack clarity. As an investor, you need to know how you're getting your money back. Okay, what Donna was explaining earlier, right, is who's the most secure, who's the second most secure, who's the third most secure, and who's the least secure. Okay, but having clarity is important because that clarity will know exactly the level of risk versus the level of reward. Okay, you have to really stress test the leverage aspect of it, and we'll talk about it. Okay, that's the debt structure. Then the market fundamentals. Okay, we'll move to the next slides and we'll talk about each of these. Okay, evaluating sponsors. The number one, and I want you to, whoever is new, is somebody who's already seasoned, either would agree. If it is new, it's something that I want them to remember. The number one, let's assume, assumption or variable is the operator. I'm gonna make this statement. The risk is not in the deal. The risk is in the operator. Okay. Say it one more time. The risk is in the deal. I'm sorry, the risk is not in the deal. The risk is in the operator who is running the business plan for you. Therefore, the track record of the sponsor that you select, okay, has to meet certain criteria. I personally do not invest with any sponsor that has not gone 10 full cycles. Okay. Full cycle
That
means,
must have been a lesson learned, huh?
absolutely. 10 cycles means that they bring a deal from inception, from the business plan to exit of that business plan. More likely, they've gone through different, at least 1 or 2 market cycles. Okay, so they've been battle tested. Okay, then the other aspect is of that sponsor is how they run their organization. Today, I don't invest in any deal of any sponsor unless they're vertically integrated. What do I mean by that? Is every swim lane of expertise within that business has to be in-house. And more importantly, the asset management. The asset management is the core. It is the team, the team that executes the business plan that has been outlined in your PPM or your private placement memorandum, which is the offering. It tells you how the plan is going to be executed. That it is the most important part of the business plan is the driver and that executes the business plan is the asset manager. And that's to be vertically integrated. the construction team has to be integrated, vertically integrated. And let me clarify that. When talking about if you have a scale, you should have a general contractor in-house. You labor, or the laborers, the ones that are laying out the floors, doing the painting, can be outsourced. But the person that handles the strategic renovation, the GC has to be in-house. If they're hiring outside contractors, if you have a scale, I'd stay away from that, not because they might be successful, I just don't gamble on that anymore. Okay. And the vertical integration tells me about the discipline of the operator. It's a full business. Okay. They're not just sourcing deals and raising capital. Now, if you have a scale, you will need to outsource labor. You need to outsource the GC work because you're starting up. I get that. I just don't invest on those. They don't have 10 full cycles. Okay, more likely. So I don't invest unless you're fully vertically integrated. In the communication standards, how often do they report? Probably by now I already checked all the investors because I've been in the business of investing for so many years now that I probably know someone that knows that sponsor, if the sponsor is being around. If they're not being around, nobody will know them. so and probably I'll get the investors to talk to me and say, hey, yep, how they reacting adversity and what have you. Because it's not about that the sponsor needs to be successful in every cycle. What's important is how they show up in times of adversity. That's what's important to me. Investment in itself it has an inherent risk, but how you drive and navigate, nobody's perfect. You can be impacted by so many external factors in the investment aspect. But it's just as an operator, if you're experienced, you're seasoned, you know how to navigate. Might not be the result that people want, but showing up and trying to steer the ship in the right direction while things are getting better. And that to me was important. Okay.
Yeah, this is very important because, well, we were caught out in 2008. We had a partner, and there were a couple of things that were not communicated. Number one, that our mortgage was assumed by another bank,
Wow.
as he was the operations, and we got a call that we had a late payment by a bank, and we're like, we don't have a account with you. So, but it turns out we did, but there have been no communication, and they were, late to pay because of 2008 downturn. So,
Yep. Yeah.
yeah,
So that's to me the sponsor is one of the very you really need to pound on before looking anything else. Forget about the deal. Forget this. If this green lights for you, that you move to the next phase of the analysis, right? Which is
yeah.
evaluating the deal itself, the debt terms, whether they're using fixed debt or floating debt. What kind of debt structure they have. Today, I do not invest in bridge loans or floating debt. Okay. If I do, they have to have a compelling offsetting factors. Okay. And the sponsor has to be battle tested. So, and I will look at reserves. I will look at a bunch of stuff, insurance cap rates, for how long, etc., and different type of sensitivity analysis in order to consider a non-fixed debt structure. Okay. The debt service covers ratio strength. Here it's important to understand all this is about sensitivity analysis, right? Question is, if the interest rate go up, can the current net operating income sustain service of debt? That's why I don't invest in floating debt, because interest can go up and down, right? It can go up more than down. And if you're not at the end of your business plan, then more likely you're not meeting your service, not service to the debt. And the same thing if you are, if your income goes down because your vacancy goes up, can you service it? What's that break-even point? How far can the business go bad or deteriorate before you cannot service your debt? Okay, at least you have that clarity what that point looks like. Pref returns today, most deals pay pref return. You need to understand the structure. You need to understand, okay, pref return is nothing guaranteed, but a good operator will always fulfill that on a quarterly basis. May have a bad quarter for whatever reason. They don't give you that targeted rate of return, the pref return, and they either give you half of that, or whatever. So that portion that did not fulfill, gets deferred on a catch-up basis when the property gets refi. The
Okay,
question
so
is, go ahead.
I'll finish.
Yeah, the question is it compounding or non-compounding? And it doesn't matter, right? Because there's other factors that can make up. The question is, do you as an investor need to know? Most investors never ask that question. They don't know whether it's compounding if it gets deferred, okay, or not. They get surprised because they might think it's compounding. It's not, okay? So that's the. Were you going to say something, Donna, on this one?
Yeah, just as a question. So a pref return, when might they be offered? Under what conditions? If investors invest a certain capital amount?
No, the pref return can be just a way. Today it's becoming very common. Just because they want to. It's a way to say, hey, you're gonna get paid before even us, like GPA, get paid. Okay.
Okay.
After the bank gets paid, you get paid as long as we got cash flow, and it incentivizes the investors to invest. That's all.
So
Right. Rather than going just
incentive.
on cash return, which can say there's no pref, we'll give you cash if it is cash, but if it's not enough cash because we need to give reserve, we're not going to give you anything. But again, it all becomes on you understanding the business and the deal, right? So, but if you got a pref return, you have to understand what are the nuances of it, right? Whether it's compounding or not compounding. And another very good, important is the exit assumption. In multifamily, you have two things. You have the purchase cap rate, which is your entry point, and you have the sell or exit cap rate. If your exit cap rate is less than the purchase rate, you have to challenge that and understand why. Okay, because that means they're being extremely or overly optimistic. And it could be so. But when you're underwriting a deal, you have to do it in with the conservative lens, responsible lens, right? They need to show you why they think the cap rate will go down. The capitalization rate means, for those that may or may not know, is basically if I were buying the building cash, what would be my return? So the lower the cap rate, the higher the price. The higher the cap rate, the lower the price. So exit assumptions, if the cap rate is within 100 basis points from the purchase, is conservative. Okay, that means they're fine. It'll be if it goes higher than that, that means that the building is not appreciating as much as you thought. It could be for different factors. But what I do challenge when somebody tells me I'm exiting at a lower cap rate than I bought it for. I say, okay, because you have already improved the property, so getting a higher cap rate is still going to give you enough equity, even though you're not, you're getting it at a higher cap rate. But when you're telling me you're selling it at a lower cap rate, what changed in the market that you're getting so much money? And that's if the deal is going to work like that because you have a lower cap rate, not a higher cap rate, then it's a red flag for me. Now you're praying.
But wouldn't some of the value add improvements make
the value add improvement is usually when you get buildings that have different maintenance. Maybe the units have not been renovated in class state, so somebody comes in and renovates them and bring them up to market conditions and compete with the new rents. Okay.
Right, but wouldn't that change the cap rate and make it a
Yeah,
more improved product?
What that does is your net operating income goes higher, right? Because you increase that. The even when what you try to think about is, even remember what I said, the word conservative. So if you are selling the property or refinance it at the same cap rate or higher, you're basically creating a margin of safety that means that even by you being pessimistic, because you increase your net operating income, you're still going to get equity available even at a higher cap rate. But if you're being overly optimistic, that means you're being aggressive in your underwriting. You say, oh, I'm going to get much more money. Okay. And is that how the deal is going to work? Only if you reach that lower cap rate, you have no other option. If you go higher, you won't happen, then we got a problem. Okay. And the way you're underwriting. Okay. So it will have to be a very
it's
good
something to
upside of the
ponder.
market, you know. So just think about the fact that
So by increasing your NOI, you're going to get a good return.
you're gonna get a return, but if return is good, even with a higher cap rate, that means it's you're creating a margin of safety. So your theory more likely will go through, and it will be a surprise if you get it a lower cap rate. That means there's more money than what you anticipated. That means the investor will get more money in the split.
Okay, that makes sense now. Good.
Okay.
Thank you.
So, but if you go, I'm thinking about you as an sponsor, you're selling the idea how much you can make as an equity based on all these levers and all these improvements. But if you go too aggressive in your exit cap by being aggressive, meaning lower than what you bought it for, then that's to me that's you're just getting gambling now too much. Especially if that's the only way it's going to work. That's the only way you're going to make money is by having the lower cap rate.
Yeah.
What changed in the market that's telling me that you're going to have a lower cap rate than what you bought it for?
Yeah, this is something nobody's discussed before, so I find it very interesting. Thank you.
Yeah, it takes, basically to get a visual, numbers, it helps out because you think about cap rate being higher, you get more money. True, if you're paying for cash, okay. But when you're dividing that increase on your income that you created, it's actually lowering the price. Okay, but it's still making the equity that you wanted. So that means that's conservative underwriting. Okay. So anyway, so that's the exit assumption. How are you going to exit this business? What is the assumptions that you're assuming? Okay. If you're expecting that the properties all of a sudden are trading at much lower cap rate, something changed in the market that you're anticipating. Tell me what that is, so I can research and understand, because I don't see that's going to change in 5 years. Especially, that's all tied, Donna, to your 10-year treasury bill. Okay.
Okay.
Okay, that's all tied to that because that's how lending is tied. So, for example, and this is just a little bit deeper in the technical aspect. The treasury bill, whatever it is, I don't remember what that is today, but if it is 4%, your lending side is about 200 points above that from an agency loan. So you're talking about 6%. Usually, your cap rates are usually 25 to 50 basis points higher. Okay. So when you're telling me that's going to be close to that's going to be much better than what we get into the treasury bill, something has to go and change in the market, and the interest rate went down in treasury bills and the bond market. There's all these correlated levers that needs to be analyzed. So that's why I'm saying nobody, a good sponsoring underwriter will tell you I got a lower cap rate.
Okay.
So.
All right. So just so I understand, we want to buy with a cap rate that's high and sell with a cap rate that's low. Is that correct?
The other way around.
No.
Buy with a cap rate that's low.
No, if you buy it at X, it doesn't matter what that is, whether low or not, it's going to be whatever the market is trading at. When you exit, you should be exiting, your underwriting assumption should say that it exit at the same or a little bit higher cap rate. And if you're making money at a higher cap rate on the equity side for the investors, that's a very conservative underwriting. If for any reason you sold it a little bit lower, that's even a double whammy. Okay, that means it's good, but that's not how you build your business case.
Yeah. So what Doug is saying here is that he's got strict blueprint for how he's evaluating his deal, and he's looking at the projections that a sponsor might give him on what the cap rate is on the exit versus what it was when they bought it.
Right.
Right.
That I understand.
And so when they when they're going to sell it, if they're too if they're conservative, let's say the cap rate will show about the same entry point versus exit, or even a little bit less. But if they're, overly projecting how well the property will be doing, the cap rate will be reduced lower. So
So
what he's saying is that's a risk that he found.
That's exactly. I'm not saying that it's not possible. It's a high risk for me because then you had to tell me what are the market fundamentals that you expect to change that I'm not seeing to exit to that point.
Yeah.
Okay.
So there's deeper questions that he's
right.
He's trying to give us a high level of why
What I'm saying
that's
is that I'm
important.
just giving you sort of I hate to say rule of thumb, but I say entry and exit should be about the same, or even the exit should be a little bit higher from a conservative lens. Okay.
all right,
Not too
wait.
high.
So the sell cap should be higher than the buy cap.
Or the same.
Or the same. And if
Higher.
it is a little bit lower, that's okay. I can deal with that. But when you start going 25 points basis or 50 basis down, that's a lot of movement in the market.
Yeah.
Yeah.
So really what you want is a sponsor who is a conservative, who conservatively
What surprise me, so sell me the business case on a conservative lens. Surprise me when you sell it and you make more money than you had told me you're gonna make. That means you sold it at a lower cap rate. That's awesome. Okay.
Yeah.
But don't sell me the business case before it happens. In other words, you don't want to over promise under deliver. Okay. You want to simply just promise and over deliver if something happens. I mean, so it's just how I looked at it, and any underwriting will look at the same thing. Remember, always look for the downside protection. Don't get excited on the IRR. Don't get excited on the excitement of upside or lower cap rates. Okay, just if you buy the X and you sell the X the same, but all the improvements you make give you this equity, great. If you try to lower your cap rate, it's going to give you even higher equity. Okay, that's what I'm saying. Why? What are your assumptions that would be a lower cap rate? That's what the sponsor will have to tell me.
Yeah. So there are questions that if you see that the cap rate is, 25 basis points or 50 basis points, the exit cap rate below the entry cap rate, there's more questions that have to be asked.
Absolutely.
Like how are you getting to that exit cap rate?
Exactly.
So the other way is if it's equal or a little higher, you still might have questions, but
it's a margin of safety.
Yeah, there's a little more safety in that.
It's tough to digest just by just talking about the terms. If you're not really knowledgeable about how the cap rates movements are, a visual helps out, give you the numbers why this makes it, and too good to be true. That's basically what we're getting at,
Yeah.
So
it's a little bit of an advanced concept here, but the important thing to remember is that if the sponsor is projecting lower cap rates on an exit, significantly lower than on the entry, there's something to question here. Is this a good deal?
Yeah, and all you got to look at the Fed states, right, and say how they moving. I said they're barely cutting interest rate. What's the projection for the next 3 years? Nobody knows, right?
Yeah.
I mean, I can look deeper that, and I can tell you, I anticipate this, but no one in their right mind will try to be extremely optimistic with everything that is going on. Is that I'm saying? It's just nobody in their right mind. So for the deal to be successful, they had to play on the safe side.
Yeah.
Because I mean, how much worse can we get? We can get much worse. Not like we did in between 22 and 23, but we can get much worse. We can get worse, yeah. But how much worse can we get? So we can do different sensitivity analysis on the higher cap rates. Really, at what point you won't be able to even refi. Okay. So that's so when somebody start going lower, and I said, I'm not seeing anything in the macroeconomics that will tell me that you're going to be a lower cap rate in the next 5 years. And that there's trends, there are charts you can look at, and you can say, well, every 10 years we see these movements. Here's the factors impacting this. That's you can start making some assumptions, but right. So
Yeah, you also have to remember that Doug comes from as a risk professional. So he's used to looking at risk. So he's
right.
sharing
So
his expertise from, being in the insurance industry for 17 years and looking at claims and going, oh, here's a downside risk. We have to protect it.
right. So look, you're right. That's exactly correct. It has served me well, and even but there's so many other things that you look at it. But this is really four aspect that I'm giving you. There's more, but this is some of the from the evaluating deals. I mean, there's all the things that we look at it, but these are very important macro. If any of these things are not tying up, I probably will walk away. Okay.
Yeah. So, I
And
mean, his blueprint is very strict criteria that he's learned over the years of investing. And
yeah,
his goal is to be work optional. And so these are like safety factors that he put in place for himself to find the best operators, find the best deals, find the best tax advantages.
what are the mistakes I see people make? Some of the investors, including myself, okay, that I made, okay, is chasing the highest projected IRR. You know,
So
when
you
you
might
look
want to
at,
explain IRR because some
yeah,
people might not.
the internal rate of return, it is a metric to measure any type of distributions plus any upside in the deal that you may have in net present value. Okay, that's really what that is. People say 18% IRR, 15% IRR. To me, really doesn't mean anything. Okay. I used to get excited, but when I started looking at the true reality of the number, what I look at it is average annual rate of return. That's what I look at. Okay. I'm not trying to say, what all these projections will look like today. I just don't, I don't look at it. What I'm saying is don't chase highest IRR. Look at what are you comfortable with? What are you trying to get out of your money? Okay. I love my 8 pref a year. And when you sell the property in 3, 4, 5 years, if you're giving me a 21% annualized return with the upsell or the upside or with the equity retained, I'm happy. Whether that turn out to be a 15% IRR, 12% IRR versus 20, I don't care about the 20. I care about getting my annualized annual rate of return. Okay. I can see it better. I can understand it better, right? I'll worry about the inflation myself. Okay. The net present value, I mean, is accounting for inflation. Okay, that's what that is. What's the value of money today versus 5 years from now? The IRA is good. I'm a finance major as well. So the IRA is good when you're comparing projects to projects, okay? Different opportunities, right? Then you start looking at those terms. But for a single investment, what I want, I'm happy with my 8% pref. I'm happy with that I get, 1.6, 1.8 my money in 4 years, or 2x. It depends. I want my money back, and how quickly I'm getting my capital back. That's really what I care. Okay. Another thing is, well, ignoring the operator track record, which we already told you how we how should evaluate it. Ignoring it is a big mistake. Okay. Okay. Big mistake. One that I talk is investing in the wrong sequence. This clearly ties to your goals. If your goal is to get cash flow, but you start investing in multifamily or developments, ground up projects that you're not going to have an income for 2 years, that you're going to start seeing cash flow when this property starts leasing up, it's been built up, and start leasing, and you start cash flowing, you're going to probably get higher returns. But that's not what your goal. That's not tied to your goal. Now people start investing in too many deals that are illiquid or no cash flow whatsoever. And then something happens to them, they come into a crunch situation and they have no cash. Right. So investing in the wrong sequence, it's important to make sure that your investment align to your goals. Okay. Overweighting one operator, the same concentration of risk, the same way of having one single point of failure on your W-2, it's the same thing with an operator. Doesn't matter how good your operator is. If 80% of your capital is with that operator, you got too much concentration risk. Now you're playing luck, because even though it's good, something could happen. One variable in the market will expose his portfolio, because he underwrites, he invests, he renovates the same way in his portfolio. So too much concentration risk. No, as much as you would love to invest in that operator because it's successful, don't put all your capital, all of it, into one operator.
So what is too much of an operator? Like, where do you
I give you I mean, if you have, let's say I'm gonna give you, if you got $500,000 to invest, that's all your capital. Don't put 500,000 on that person.
Okay.
Put maybe 30%. If you love him so much. Okay. I don't know, whatever you feel comfortable with. Okay. If it's your retirement money, be careful. If it is disposable money, be careful. Right. So it just think about the concentration rate. The question to be, if something goes south, what happened with that money?
Yeah.
The same market, the same operator. It could be, you create an unnecessary risk. This is an insurance perspective as well. When you got too much exposure in coastal areas, you're exposed to hurricanes, at least in South Florida, flooding, all this stuff. What do the insurance do? There are two things they do. They de-risk by reinsuring, okay, or limiting the number of exposures in the area. They reduce the policies. They get rid of the policies. They dump the homeowners of the policies. They sell the portfolio to somebody else because it's too much risk. The same thing. You can be getting high premiums on a policy and be fine for 5 years, and then you got hit with a hurricane that will blow you away and will got losses, even though you got reserved for many years. So that's you de-risk by setting up a layer of reinsurance, which you pass on the premiums and you pass the losses.
Yeah, interestingly enough, my first IT role was in the reinsurance department.
So it should make sense. And the people not understand the capital stack. We talk about the capital stack. It's important to know when you're going to get paid. Whether you're in the higher risk band or you're lower risk band, okay?
Who's getting paid first? Yeah, and what percent? Good.
Case study real quick. I know that we're running out of, maybe I don't know how much time
No,
we got.
you have about 40, let me see, 40 minutes. Oh,
Oh,
no,
really?
20.
No.
I'm sorry, 9 o'clock it ends. 20 minutes.
Okay, so I think we're coming to the end. The question is case study. So I'm going to give you I'm very bullish in the Midwest, specific in Cleveland. Okay, Cincinnati, Columbus, and Cleveland are very good markets, but I invest in Cleveland. I'm biased a little bit because my mentor is there as well. Okay, he's fully battle tested. So today, any investment that I'm making in multifamily, it's just with him. Okay, and I don't have too much concentration or risk. But if I'm going to invest today, I invest there. Number one, 20 full cycles, a battle tested, 3,000 to 5,000 units in his market, backyard. He commands the rents, the comps. He has a rinse and repeat model. He's vertically integrated. He has everything that can make successful an operator.
Mm.
So when you get a rinse and repeat, it's easy. I know he's underwriting. Number one, he's my mentor. So I'm in the acquisition team. So that's another thing I haven't said. Even though I'm not an active role, but I'm in the acquisition side mentoring because I want to see how they're thinking, what's trending, what they're seeing that I'm not seeing from a passive side.
Interesting.
Okay.
Yeah.
So I
Someone
underwrite deals.
asked, what's that?
I can underwrite any deal just about,
Yeah, it's great to underwrite deals.
Yeah. So that's Cleveland, so that's, and he pays an A pref, and his mark is 36 months to 42 months hold. You get your money back. He tries to hold properties. So you get your money back, you get your distributions, and you retain equity in perpetuity.
Oh, that's nice.
So that means until he sells the property, he might hold it for 10 years. So you get your money back, you get your distribution. Now there's no more pref, but you're getting the equity cash flow. So whatever you invested in proportion to the equity, that's what you get. Right.
Nice.
So now that's just one way. If he has to sell, he sells it, and you get your upside.
Okay.
And that's the Cleveland, but it's 36, 42 months. He rarely goes to 5 years. So then you got the private credit income.
If you could explain that, because we have a question about that, what it is.
Yeah, what's the question?
What is private credit income?
Private credit, basically is collateral back lending. Okay. So we talk about the flippers. That's private credit, right? So you lend money to professional rehabbers, real estate rehabbers, right? And one of the credit funds that I invest, we have a very strict guidelines. 780 score. They had to have about 6 months of reserve for the project. They had to have, I think it's 25%, 30% in the skin of the game, in the deal. Very conservative. Then we sell 90% of the loan to an institutional lender, and we retain a small piece. We make money on the delta plus the full interest on that piece, and then we make. That's private credit, but it's
Is that the same as hard money loan in a way?
No.
So what's the difference?
But I think the interest rate, I don't recall the interest rate. It's not a hard money loan. No, it's not a hard money loan. But I think it must be around 12% today.
Okay.
So it's getting up there, obviously, no? But it's just asset base. So, who's the operator behind that? Now, this is a fund. This is not a single asset. So now the operator, when I did the due diligence, it's a different type of due diligence. Who's behind the fund? Well, the people that are behind the funds are Fannie Mae, Freddie Mac, risk managers of 30 years of experience. They know that market, right? They know the lending aspect of it. So that's how they de-risk it, because they sell a loan and they don't retain a small piece, and they get paid because they sell it for less interest rate. So they still collect a piece of it, and they retain for the smaller piece the total amount. So it's a pretty well designed. There's the multi-asset fund, which you may have a multifamily, a retail, industrial, and medical offices. So it's still portfolio based and geography based. But the control that I like there is Combined loan to value 65, max 70% between, we got some mezzanine or pref, okay? And we got control rights of the property, or we have takeover rights if something's not going well.
Hmm.
Again, the people behind the funds are first-class underwriters, first-class operator, because they also operate. So this is the type of deals of partners and underwriters that I look for, right? They might not be the highest return. I don't care. But if I'm getting my 9 to 11% annualized and get monthly, or if I'm getting my 11 or 14% because I compounded, that's a good size return. That's part of my income engine. Okay. I get it monthly. I get profit shares quarterly. I got 2-year commitment or 1-year commitment, depending. I'm gonna give you I didn't write it here, but I'm gonna give you one failure in multifamily, in the failure I'm lending from. No, it's not mine, but it's a colleague, which is a good example. In multifamily, one of the failures that I had, and I failed, and I should have known better, was in the asset management. I got sold in the idea, this is a big multifamily guy, 13,000 units, great operator. He expanded into geographies, successful in that market that he was entering, had already 3 or 4 cycles, but cycles of a year. It just, they were flipping the property basically. When I got flashed by the size and the experience of the operator. I did not dig deeper enough into the layer of asset management. The asset manager was 5 hours away.
Oh.
Okay, so when things start getting south, that becomes a problem. The distance.
Yeah,
that person
definitely.
needed to live there. There was no way he could be living in that person, okay? But, and on top of that, you got interest rate issues that they were having. So all that combined, the business plan did not get executed on time, and that became a problem. So, and compounded with the effect of interest rate. So the issue is become the asset management. Because one more thing I can tell you, you can have all the interest rates issue because it was market driven, but if your business plan get executed and you're running a 92% occupancy, lenders will work with you because there's nobody else can operate that building better. It's a matter of the servicing the debt. So the banks start doing extensions, modifying loans, because they know the operator has done the business plan. The interest rate was an issue that just the speed with what they went up, nobody anticipated that. That's okay. So there's 2 different type of a scenario, right? So one that you can control, which is the business plan. If you add the interest rate, then you're dead. But if you met your business plan and you're running a 92% occupancy, which is what the lenders ask for you, because basically you're maxed out, okay? They will work with you. They cannot get any better than any operator that can run that better. So why would they change that? It's such a disruption for them. So that's an example of why asset management is so important. Okay. And in the lending fund trend example, Donna, he invested into, I'm not sure he made a post to that, and we'll talk about it. He invested, X number of dollars into the deal. Had a long term of successful distributions. We didn't go into the fact which type of loan is, but based on what person read and told me, is that thing is, it was other type of funds not related to I think real estate. I'm assuming here, but here's what's important about this. When he got into the deal, there was a 5% delinquency on the fund.
Oh.
Okay, which is that good or bad? Yeah, unless you get context, you don't know.
Yeah.
Okay. So 5% delinquency. When the next 2 months, when he got the loan tape, it had gone up to about 10% or something like that. That was fatal. Okay. Because if you got 5% going up in a credit card, might not be as bad. It's trending in the wrong direction, but if you get something in, I don't know, any type of other portfolio, that might be just fatal, and that's what was happening here. So distribution got suspended or reduced while they were fixing it. My point here is you got to look not just the number, but the trend and the context within what it develops.
Okay.
That's important. So 5% is bad or good. I don't know unless you tell me what we're talking about. Okay.
Shouldn't make
So
snap
that's,
judgments. You got to dig deeper.
yeah. So that's really the sort of a case study. Here's my portfolio allocation. Okay. We're asking that question. 50% private credit income. Okay. That fuels my cash flow in my retirement today. Okay. 30% is a multifamily, and I think it's might be doing because this is growing. It could be a little bit more, but the percentage stay the same. 20% alternatives, right? Anything, any opportunistic deals that you're getting that might not be totally into these buckets. Okay.
Okay.
Okay. So that's how it's allocated.
Well, there's so much value here. I think we'll have to listen to this a second time to really absorb it all. But I love the information you share because you have put together an actual blueprint for what makes you work optional and
Yeah,
how.
and I'm gonna make something clear because people ask me this question, even after I've given some talks, and I said, "Do you replace your income?" I said, "No, I did not replace my income. My income was pretty high." I said,
Okay.
"I cover my essentials. I never needed my income to live on my income, so that's the reason why I said was saving money and was able to invest money." Okay, so I live very comfortably with what I had.
Okay.
So now, if you make 300 grand and you spend 280, you got a problem. Okay.
Yeah.
It may or may not. I'm saying you're tight. I just did not need to spend 300. That's all.
Mm, makes
Okay.
sense.
But what I did build reserves, which were money market accounts. I had about almost more than 2 years in reserve, maybe a little bit too much. But the reason why, why I went that high is because of the uncertainty of the layoff.
Yeah.
Right? I was investing all my bonuses into real estate and credit funds and all this stuff, but I was also building money for immediate, right? See if I wanted to do that. If something happened, like I said, I was fortunate enough in 2024 July, I I I I left the company. I took an early retirement because it was an opportunity for people that had a number of years served. It had to be approved. I signed up the last minute. I was not going to sign up. Um, called my boss, and my boss says, "Are you sure you want to do this?" I says, "You're in a very unique position." I said, "No, that's fine." I said, "I think I want to go and do. I just want to go and see what I do, And this 2025 has been sort of an evolution. I started learn how to raise capital. It's skill I did not now. I mean, how to understand how to raise capital. Um, I know how to invest. I said, well, let me just show people what I learned. I mean, and I learned from a lot of people and that I met in LinkedIn, for example. There's some really great investors. I mean, really savvy people. And I said, well, let me just share my experience, right? And how that book came about. And now I said, you know what? I'm building my own fund, right? I'm going to be part of a credit fund organization.
Mm,
But I'm working because I want to, I choose to, I don't have to. I just came back from Colombia for being 3 weeks away.
wow.
Okay. I was in El Salvador 2 months earlier for 2.5 weeks. I was in Colombia in March for another 2 weeks. So, right, I'm taking it slowly, taking my time. I was in the Andean region in Colombia. and sipping the best coffee of the world, and monthly distribution were hitting in my account, okay, in quarterly distribution. So that was man, that's a realization, right? I mean, and I don't want, and I'll say this to brag about it. I'm saying it just take that concern away, and it paid my essentials. It certainly pays certain luxury I may have, but I'm a simple guy. I'm not a guy who overspends. I just do. I want to just live comfortable you know, and on my own terms now, right? So.
Yeah. Well, that's fantastic. There are a few questions in the chat. So, how long did it take you to achieve your financial freedom goal?
Okay, good question. Before we answer that, the truth bomb is high income is not financial security. I want to just to say that, okay? So I think in 2023, I was there. I wasn't really counting on it, just happened to be in 23. I realized that maybe I had enough to cover my essentials, it take me, so I would say about 10 years,
And
uh, 9, 10 years. Um, it Is it a lot of time? I don't know. It just depends how you want to look at it, right? But there's no such a thing as an overnight thing. Okay.
yeah.
Just there's no such a thing. So I've seen people done in 5 years, Donna.
Mm.
Right. I mean, maybe they have a much even lower essential number than me. I don't know. Right. I just don't know. But I think it's about 10 years, I would say that. Now, one thing that people need to realize is the fact that you become work option and you got passive income covering your essentials. It does not necessarily mean that you had to relax, because investments come full cycle. They finished. You had to continue to reinvest, to continue to get that machine, that wheel turning. Otherwise, it will stop. Right. So it's not like in perpetuity, right? Because my income engine is based on 1, 2, 3 years max.
Got you.
I got to layer up different type of things, and so I just kind of So the work is you have to be always on the go, but that's a small effort.
So even if you're a passive investor, you still have to pay attention to what's going on in the
That's,
cycles.
that's why I monitor my reports. I take a little bit of dashboard there that I look at. Okay, um, you know, and distributions get suspended once in a while. Things do happen. I mean, it's not a happy linear path like you think. I want them people to get the wrong impression that, oh, you reach. This is not an annuity, by the way. This is not an annuity where
No.
you get guaranteed, but this is just passive income, and you keeping your capital. It's capital preservation plus passive income, which is better than the annuity. Okay, the annuities you get almost guarantee up to age, no, I don't know what, but you have no more capital. Okay.
Mm.
So here I'm just doing you know, I'm constantly looking at deals. Um, at one point, probably I won't have money to invest because everything will be invested in producing, but that's what you want. You want the money working for you. Okay.
And then all onshore, all your money is invested in the US, or you?
Yes, no, yes, just US for now. Yeah.
Okay.
Yeah, I don't think I want to go. I don't invest in anything that you don't know of or don't, I just,
Yeah.
it's so it took me about that long to focus. It's just also a mindset. It's a mindset shift. Even when I did it, you
Hmm.
always get nervous
Sure.
because the reality is, even though before joining corporate, I was on my own for 10 years. So I had that spirit of being on my own also before, but you get used to the W-2. I call it
Oh,
the
yeah.
W-2 trap. Okay.
Yep.
And when I was gonna pull the plug, I, I was nervous, and I said, "But why would I? Why am I nervous? But it's just that bi-weekly paycheck, right? It just gets such ingrained into your brain. When you realize today, I don't worry about paychecks. I just For the better part of the last year, I was like shifting money into my personal account just to see I was getting a paycheck, which didn't make a difference anyway. Today, I don't. But
Yeah,
anyway,
there are few
yeah.
more questions. Thank you, Stefan, for being my co-host today.
You're welcome. Mr. Escobar, while there's a break, can I get your phone number?
Well,
Yep.
yeah, he'll put it in the chat, and
You'll
but,
send it to me?
yeah.
Okay, cool. All right, Mr. Escobar, thank you very much. Donna, thank you. Love
Okay.
you. You take care. All right, bye.
Bye.
Thank you.
Thank you. Yeah, if you don't mind putting your contact information in the chat.
Okay, let me just
Oh,
give me a second here.
sure. And then Rakshanda wants to know if you need an assistant, but then she said, "Just kidding."
You know what? That's a great question. I'm thinking about it. I'm not there yet, but I think I will, just because as I grow my fund of fund
Mhm.
business, I definitely will need it. Just because I've done everything I can with AI to stretch my dollars, right? Not, but eventually I will. Yeah, probably.
Yeah. Okay, we have a question. Nigel, do you want to ask your question, please?
No, I was just going to tell him it was a great job. I appreciate that.
Oh,
You know, it
thank
opened
you
a
very
lot
much.
of my eyes on a lot of things that,
But
especially
but
the.
you asked the question about
No, I
building up.
just mentioned that you still, at the end of the day, you still have to build up to be an accredited investor. So you're just not going to jump in there unless you have a nice bunch
Yeah,
of cash under your bed somewhere.
what you, the way I would do it if I'm I was it was a, if I was an accredited investor, I would look at the 506B opportunities. And here's why: you don't need to be an accredited investor, but by attending to certain, if you start studying and just looking and going to meetups, investor clubs, you start getting to
Hmm.
develop a sense of savviness on the investment world. That by itself will make you knowledgeable enough. And as a 506B offering, with an exception under the SEC, the Security Exchange Commission, would allow you to invest in opportunity that is not publicly advertised, but just by, if you know Donna, if you know somewhere that has a deal, then and you have a substantial relation with that person, then you can invest. And the beauty of that is also they can let you invest at a lower amount than the standard is. Okay, so if I were you, I
Uh,
would start on a 506B. But the most important question, Nigel, is that you should ask yourself is, can I invest that amount? Is it gonna break me or not? Is it gonna mortgage my house or not if I lose that money? And that's the question. There's no other way of putting it. There's no need to sugarcoating it, because you could lose your money. Like in any
exactly.
investment. I mean, you lose it
It
in the
is an
stock market,
investment.
right? Today you're
It's
up
an
20%,
investment.
tomorrow you're down 20%,
Right.
So
Exactly.
yeah.
All
Oh,
right, so
I got one more thing,
okay.
Mr. Escobar. If you remember when you said your friend gave you $2,000 to buy your own building or
Oh,
condo,
yeah.
so if you ever want to play it forward, I'm ready, eager, ready, willing, and able, and to take that next step.
When just the story for that is, at that time I really didn't have $2,000, right? And I had a friend of mine, he was pretty well off, and said, "Hey, Doug, I know you like his real estate," and he was big time in real estate. Here's $2,000. You told me about this condo, and I think it was 4,000 what I needed, so I had $2,000, and it was a $35,000 condominium back then.
Wow.
And I sold it for $65,000, $70,000 a year later. And the reason I sold it is because I could not rent it more than once it was in the year. Okay, I learned that. I never knew about
Mm.
it until I didn't read the bylaws of the association. Okay, so they had a rental restriction. So I said,
Oh,
so when my tenant bailed out, I said, hey, I'm not going to stick it to the thing. So I sold it, and surprised I was getting twice as much. You know,
Wow,
so
that's
all right. Well, I'll
awesome.
be interested in your, once you start up your fund to fund, that sounds like another avenue that you don't probably need. You're not gonna be taking all accredited investors, are you?
Yeah,
At
no,
that point
this
when you start to
the
fund the
one that
fund.
I'm partnering with is gonna be 506C, just because The mothership fund is 506C. I can't change that. Okay.
Oh,
Okay.
Yeah.
Well, so people that you bring on your side of the fund has to be the same.
yeah.
Yes. Yes.
Yeah. Okay. Gotcha.
Yeah.
And what's the minimum investment rate or amount?
So the mothership fund requires 100K, but in a
Okay.
fund of fund, I have my own limits. I can set up anything. Like I use my own discretion. Okay.
Okay.
So it just depends on the person that I mean, what I value is who the person is. Is it really the person is serious and it's just want to test the water and gonna get in it? I lowered obviously the benefit of going with a fund of fund is you probably will get into with the fund at a lower entry barrier than the actual mothership fund. Number one, because they give priority to the fund of fund managers for obvious reasons, right? They rather have less people. That brings more people under their umbrella. So, and that's the reason why they have this higher entry barriers. If you're gonna come directly, number one, they tell you we're gonna put you on the waiting list until we're done with the fund manager. When they didn't meet our quota, you're coming in. If not, you can't. And secondly, this is the higher entry barrier. So if you go with them, you probably go with lower. So
Okay. So
All
we
right,
have to
thank you.
wrap this up. Do you want to just finish your next steps and then we can?
yeah, listen, I do have offer a master class. It's a 5-day email series. It is on multifamily. Okay, it's part of what we cover on the guardrails, more in depth. Okay, I think more structure. And basically you can go in, and that's the link there. I can put them in the chat if you want to.
Yes, please.
Let me see
And
here.
I can send them out.
Let me see if I to.
Yeah. While you're doing that, just want to say, this is very informative and just a great master class. I mean, really give us some food for thought to think about how we want to structure our own deals, our own freedom number, to
Yeah.
and to
I'm
be
gonna put also
conservative.
the here Donna the book just in case somebody wants.
Yeah,
And
and that's a great book. I actually read it in 2 days. It
I'm
was
downloading it now.
yeah, and what you'll find in there, which we didn't even have time to talk about, so we'll have to do it another time, is Doug has a virtual board,
yes,
and you'll see it's Warren Buffett, Robert Kiyosaki, Jim Rohn, Tom Wheelwright, a few others.
Mark Cuban, yep.
Get in on that board, Donna.
Yeah, I'm going to be on the board, sure.
Yeah.
I think it's the other way around. Doug will be on my board.
I hear you. All right, guys. It's good talking to you.
All right. Well, thank you all very, very much. The replay will be available in about a week's time on our channel, youtube.com/at hookup with real estate. And feel free to like and subscribe and comment on our channel.
Thanks, Donna, for having me. And
Yeah, yes.
Good night.
okay.
Good
And
night,
good to see
everyone.